Welcome to Colibri Real Estate, transforming lives one home at a time. I'm Lisa McKim, and I have been a practicing agent for over 17 years. I'm licensed in California and in Colorado, and I've also been teaching for 8 years. Today, we're going to dive into the topic of tax depreciation. Understanding how to calculate depreciation is crucial for real estate investors and professionals. Let's break it down step by step. First, let's clarify that there are different types of depreciation. There's depreciation for the cost depreciation approach, there's to appraising, and there's tax depreciation. For this session, we're going to focus on tax depreciation. Tax depreciation is taken on what we call a straight line basis. This means the property value is divided over a certain number of years to calculate the depreciation for each of those years. For residential property, that time frame is 27.5 years. And for non-residential or commercial industrial properties, the straight line time frame is 39 years. Let's take a look at a question. This question says, a 100-unit apartment building sold for $3 million. Closing costs are $26,300, and the land represents 30% of the value. How much depreciation can be taken for each year for income tax purposes? First, remember that land cannot be depreciated. So we only depreciate the building and the expenses incurred in purchasing that building. The purchase price was $3 million, and the closing costs were $26,300. Making the total acquisition cost $3,026,300. Since the land represents 30% of the value, we can only depreciate the remaining 70%. To find the depreciable basis, we multiply $3,026,300 by 70%, which gives us $2,118,410. Since this is residential property, we divide that by 27.5 years. The amount of depreciation that can be taken each year is $77,033.09. Now, let's take this step further with another example. This question says, if the annual depreciation allowance for a small shopping plaza containing 12 stores is $25,000, and the land represents 20% of the purchase price, what was the purchase price? Here, we're working backwards. We know the annual depreciation is $25,000, and since it's a shopping plaza, the depreciation period is 39 years. So $25,000 per year times 39 years gives us a depreciable basis of $975,000. But this is only the building value, which represents 80% of the total purchase price. To find the total purchase price, we take the $975,000 and divide it by 0.8, or 80%. This gives us a total purchase price of $1,218,750. This example shows how different concepts can be combined in application-oriented questions. You need to know the depreciation period for different property types and how to work backwards using the if-then formula to find the purchase price. That's it for today's session on tax depreciation. I hope this helps you to understand how to approach these questions. Thanks so much for watching. If you found this video helpful, don't forget to hit the like button and to subscribe to the Colibri Real Estate channel for more tips and tricks. Good luck, and see you in the next one.